Reflecting the weakened state of the U.S. economy and the distressed real estate market, U.S. property casualty financial impairments have spiraled upward, a trend opposite that of the U.S. life health segment. Senior Manager John Lafayette and Carol Ann King, Managing Senior Business Analyst, explored 2011's count.
But there were 34 property casualty companies that became financially impaired in 2011. That represented a pretty significant jump over 2010.
It also is in stark contrast to the experience of the life health industry, where there were only 2 impairments. So you can see it's been an unusual year, even in terms of the past 3 years' trends. The impairments took quite a leap.
It started to approach the impairment distribution that we saw in the early part of the decade, when you had the dot-com bust and also a salary economy.
In contrast, though, on the other side of it, if you look to the 1991, when there was a lot of catastrophe losses, the impairment rate was much higher. And we think the reason why the impairment rate hasn't gone that high is the fact that the industry is so well capitalized.
A consistent finding in AM Best's 42-year study of financial impairments is the rate typically peaks at the end of soft market cycles. Group Vice President Anthony Diodato said that in this case, the PC industry had learned from previous missteps.
Back 20 years ago in the early 90s, there was a very competitive landscape, a lot of underpricing. We had significant catastrophe events, but the industry had not honed their risk management skills to where they are now. And I think that's a credit to the industry. They recognize that inadequate pricing and risk management on the cat side, and even looking at as the confluence of events come together in that aggregation of risk, the industry as a whole has got much better at looking at that and understanding the risk and saying this is too much to take on, and they have to mitigate that risk to various areas. I think another thing to look at is the commercial lines market. You have more maybe in that area because the dynamics are different. You have an unregulated industry from pricing point of view, and there's many different segments and niches within the commercial lines. And with price being the driver, you're going to have companies that go out there and are very competitively pricing. That risk, they won't know until, depending on the tail of the line, it could be 3, 4, 5, 10 years down the road. And if you inadequately price now, when that loss comes on the books, 10, 15 years from now, if you're not adequately priced and reserved, you're going to have to add surplus to cover that shortage. And I think that's what you see in the commercial line segment, is that you don't have the price discipline.
Driving the impairments in the last 3, 4 years have been the weak state of the economy and particularly the bust in the real estate market. In 2011, about 1/3 of the impairments were failed as a result of the effects of the real estate bust.
But surprisingly, the catastrophe losses, which have been, extremely high, 2010-11, did not play a material role in impairments. We had one group consisting of 3 companies that went out due to tornadoes, and that was it.
When most people think of impairments, they draw their attention to catastrophe losses. And we, in our process, focus on cat losses because it's a significant shock to a company's balance sheet. You can lose a lot of surplus. The interesting point, if you look over the last 40+ years that our study does, cat losses rank number 5. Even in 2011, when North America had a substantial amount of cat losses, it was not the number 1, it was the 3rd loss. And I think that's a credit to the industry, is that they have gotten better in managing the risk. And it's a key part of our analysis when we talk to companies, is looking at the aggregation of risk. And cat is the number 1 item that we look at. But I think it's important for the companies that got impaired, it's not cats, it's not just reserve development, it's not investment markets, it's the confluence of all those coming together. And that's a big part of our enterprise risk management approach, is to look at the risks as they aggregate and see if companies understand what they've got on their balance sheet or what potential exposure they have in the balance sheet. Because many of the companies that become impaired, they don't realize they've got a little bit here, a little bit here, and a little bit here. And when you aggregate those items together, It's that significant loss to the balance sheet that causes many impairments.